Good morning and welcome to KBRA's Private Credit Webinar, Feeder Fund, Rated Notes, and Credit Facilities. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Additional research regarding this topic, as well as our ratings reports, can be found on our website at privatecredit.kbra.com. This dedicated page contains all of our private credit information in one location. You can also access this page by scanning the QR code on your screen. All research is complimentary, and you will simply need to create a username and password online to access our thought leadership. Should you have any additional questions on the topics discussed, we are always available for a follow-up call. Now I'd like to hand things over to our esteemed speakers for introductions.
Thank you, Caitlin. Good morning or good afternoon to those joining us from outside the US, and welcome to KBRA's Private Credit Webinar discussing feeder fund rated notes and credit facilities. My name is Neglia, and I'm the Global Head of KBRA's Funds Rating Group. At KBRA, our funds team includes over 50 analysts based in New York, London, and Dublin. We're dedicated to delivering analytical excellence, providing rating transparency, and adding value for our clients and investors. Across the private credit markets, KBRA maintains a leadership position with over 900 ratings for over 100 unique sponsors. This includes over 250 rated NAV or sublines, 100 plus private credit facilities, 275 transactions with ABL collateral, and over 150 feeder notes. Today, I'm excited to be joined by a panel of experts from KBRA who authored two of our latest research reports on private credit: John Hogan, Tom Spiller, Min Chu, and Katherine Quirke. I'll ask them to introduce themselves shortly. In today's session, we'll discuss key insights from the following reports: private credit feeder notes and credit facilities remain resilient, and private credit feeder fund rated notes squaring the circle. In addition to many other private credit research reports, private credit market participants can access KBRA's Middle Market Surveillance Compendium, which is a quarterly report that examines the financial health of nearly 1,400 middle market corporate borrowers within the private credit sector, as well as KBRA's DLD Default Radar, which is a monthly tracker that identifies and monitors credits in the US direct lending market that may be at risk for default. Both of these reports provide insights into borrower performance and the potential for default risk. As Caitlin mentioned during today's webinar, you can submit your questions throughout the session using the chat button, and we'll do our best to address them. So with that, I'll turn it over to the panelists to introduce themselves. Tom, would you mind starting us off?
Yeah, good afternoon or good morning, everyone. My name is Tom Speller. I'm the Global Head of Fund Finance Ratings, also the head of the European Funds team based in our London office.
I'm Min Chu. I joined the funds team about 4 months ago to focus on research efforts for the team.
My name is John Hogan. I'm the co-head of Europe, so focused on our analytical efforts in the region, but I've worked very closely with the funds group over the last number of years in legal capacity, focusing on structure and documentation. And that's involved a lot of work on feeder fund rated notes and other rated notes such as GP-CFOs.
Hi, I'm Katherine Quirke. I'm a senior director in our ratings legal team, and I work across quite a wide range of practice areas, including structured finance in Europe and rated note feeder funds globally.
Great. Thank you all. So let's start with the basics. Tom, can you describe the feeder fund rated notes and credit facilities? What are they? How are they used? Who invests in them? And why are ratings important?
Yep, absolutely. So I guess as shown in the structure chart, I guess starting with our rated note universe. So in a simple rated note structure, a feeder fund raises debt and equity commitments from investors and makes a corresponding equity commitment into a master fund or a fund. That master fund then finances investments by calling capital from its limited partners, which would include then, of course, the feeder fund. The feeder fund will then meet the capital calls by drawing on both the debt and the equity commitments provided by its own investors. And as the underlying investments then realized from the master fund will return capital back to its LPs, and the feeder fund will repay the rated debt advances and the equity contributions in accordance with a defined priority of payments. So we've been actively rating, I guess what I refer to more commonly as a feeder fund rated note, or a feeder fund, almost in some respects similar to a CFO or CLO, but not exactly, given the nature of these, the way in which the investments are funded over time. But we've been pretty active in this space since 2019, but with a real growth in the ratings in 2020 and onwards, which we think is also aligned with the broader ratings market for these types of structures. In contrast, I guess, with credit facilities, so credit facilities are facilities that are secured obligations of the private capital fund itself, the private credit fund. So if you're looking at the structure chart, it would be a facility taken out at the master fund level, or potentially in a drop-down SPE, or special purpose entity that holds the underlying assets. Typically, these are a substantially identified portfolio of loans, as opposed to in the case of a feeder fund rated note, where you're ultimately could be coming in at an earlier point of the life cycle of the fund. But ultimately, the credit facility here is then secured in the underlying assets of the fund. Typically, these are used by funds that have a defined leverage target. So the master fund having offering its investors a levered return target within the LPA. So in terms of, I guess, why ratings coming into play. So we're certainly active in both credit facilities and feeder fund rated notes. And typically these are important for certain types of investors, such as insurance companies. In the case of credit facilities, we also are working with originators such as banks who may have a benefit from having a rating on the facility for their distribution efforts, again, to potentially bring in alternative types of lenders such as insurance companies. In the case of feeder funds, as well as obviously investors such as insurance looking to participate that could see the benefits of having a rating on part of their commitment, there's also, I guess, the ability to attract other types of investors into these structures who have varying risk return targets and want exposure to private credit, potentially in a different exposure from a risk return basis as well. So for example, looking at almost like an investment grade rated debt instrument into a private credit fund, as opposed to taking a vertical strip in the underlying structure.
Thank you, Tom. Appreciate the overview there. So you mentioned that we've seen an increase in rating activities recently. Min, can you walk us through some of the issuance statistics, what the rating distributions have been, and what are trends and expectations for the future of feeder fund rated notes and credit facilities in the near term?
Sure. Caitlin, if we can go to the next slide, please. So this shows you KBRA rated feeder funds and credit facilities with exposure to corporate credits issued between 2018 and first half of 2024. Volume has been strong. Our rated portfolio totals 87 transactions with a total issuance amount of $27 billion. And that includes about $20.5 billion attributable to feeder notes. And those are, just of note, that includes both the debt components and the equity commitments. What we see here is that, there has been a tremendous growth in 2021 and 22, followed by a slight drop off in 2023. However, 24 volume has been extremely strong, led by an increase in feeder volume in particular, and we expect full year volume to exceed 2022 volume at this point. If in terms of the trends of ratings, if we can go to the next slide, please. Caitlin. So this shows you the rating distribution by issuance year in terms of tranche count, so by each rating category for each of those years. What we've seen, interestingly, is that initially we tend to see just one debt tranche and one equity tranche in the feeder notes, whereas more recently, 2 tranches or 3 tranches have been more common, and often these structures also include an investment grade tranche. So what we're seeing typically is that, some of the equity, that the composition that otherwise would be equity could be part of it could be issued as a below investment grade tranche. So that is to address the varying risk return profile from insurance clients in particular, and we do expect this trend to continue in the future. Currently, our book is about 3/4 investment grade and 1/4 non-investment grade. Back to you, Eric.
Great. Thanks, Min. That's very helpful. So let's go ahead and shift gears and we can discuss some of the structural and legal considerations that differentiate credit facilities from feeder fund rated notes. John and Katherine, can you walk us through the key structural aspects, particularly how these structures rely on asset cash flows to pay down debt versus equity distributions, as well as the nuances around calling capital during the investment period, as well as recycling distributions?
Sure. I think from a structural perspective, you've already highlighted the key difference. Perhaps it's even like an organizing difference between feeder fund rated notes and credit facilities. Yes, they both look to middle market loans. They both look to corporate credit. But a credit facility lends directly to those assets. It lends against those assets, while a rated note is accessing those cash flows indirectly through an LP interest. So this means it's dependent on distributions from the fund. It also means it involves a broader exposure to the fund, its development, its performance, how it's managed. Whereas a credit facility is typically structured around a borrowing base of eligible assets, subject to concentration limits, and in that sense, like a sort of more defined subset of overall fund risk. Now, to be clear, this isn't a bug. This is a feature of rated notes. For investors, for GPs, a rated note transaction is a way of committing investment dollars into a private credit strategy. And that brings us to the second part of your question, Eric, and the theme we explored in our recent research report, which is essentially like that, yes, the dollars committed to a rated note structure are true investment dollars from a GP perspective, but they're not quite the same as dollars committed through a regular LP interest. And ultimately, this is because there's a limit on just how far you can go to accommodate some of the legal features of LP interests, which are governed by limited partnership agreements. So how far you can go to accommodate those legal features within a rated debt structure. I'll touch on one or two of these and just kind of talk through the tension that arises, and then I'll hand over to Katherine, who will take us through a couple more. So I'll start with that profile you mentioned, Eric, of calling, returning capital, or borrowing and repaying principal. And similar to a credit facility, the debt and equity in a rated note structure are typically drawn pro rata during the fund's investment period, and then the deal switches to a sequential structure after the investment period. In contrast to a credit facility, though, a fund's LPA will typically allow it to make further capital calls following the end of the investment period. Now, this could undermine or even undo the build and credit enhancement that we would expect to be underway during this time, because you're in a sequential paydown structure. We've typically seen this addressed with a kind of maintain or improve approach. So during the investment period, you can draw pro rata based on commitments, but after the investment period, you switch to drawing again pro rata, but now based on drawn balances rather than commitments. Something similar comes up with respect to recycling. Some LPAs would allow income distributions or interest payments on the notes to be recycled and drawn again. But in a debt structure, so in a credit facility as well, you borrow, you repay, and you reborrow principal, not interest. And the way we've typically seen this resolved in rated note structures is by having the equity pick up the slack. So essentially, you would recycle that interest component into the equity commitment rather than into the debt commitment. And in that way, we sort of resolve the tension and accommodate, as far as possible, the particular feature of the LP interest within the rated debt construct.
Thanks, John. I might pick up on a few more here. So there's obviously a whole range of features that we can talk about in the context of feeder fund rated notes, but the two that I wanted to talk through, is I think they're particularly interesting and relevant in the context of our discussion, are default provisions and withdrawal. So starting with default, the way we think about default in the context of a feeder fund rated note is that default remedies shouldn't operate in a way that undermines the economic entitlement of the rated debt instrument. Or put more simply, default remedies need to be debt appropriate. So taking a step back to think about what that means, if you think about how a standard debt instrument works, if a lender fails to fund, if you have a defaulting lender, there's a pretty standard set of remedies that a borrower can use. A borrower can repay a lender and remove them from the structure. A borrower can transfer their interest to another lender that will take on their funded and unfunded commitment and essentially remove them from the structure again and have another lender fill their shoes. And there will often be provisions that will essentially shut off a lender from voting rights and information rights, or have them deemed to consent to certain amendments and waivers. So essentially the defaulting lender becomes disenfranchised or shut out from decision making. But things work a bit more differently in a fund structure, in a feeder fund rated note structure, in that funds often have a lot more extensive remedies or default remedies in the context of an LP who has failed to fund. So as well as the ones that are relevant in a debt context, a fund will often be able to exercise quite extensive set-off rights. So amounts that are due by the defaulting equity holder can be set off against distributions owed to the equity holder. The fund can take this further again and in some cases shut out defaulting equity holders from cash flows entirely until the winding up or dissolution of the fund. And we've seen provisions that allow the fund to sell underlying assets, potentially at quite a steep discount, and use that proceeds to cash out the equity holder at a loss on their end. And fundamentally and quite crucially, the kind of key default provision that you see in an LPA is the ability for the fund to simply write down the interest of the defaulting equity holder. So any defaulting equity holder essentially loses their entire economic interest in the fund by virtue of their own bad actions. And why you can see that's a very useful construct in a fund, in a context of a rated note feeder fund, where the debt instrument is relying on cash flows flowing through an LP interest, it doesn't really work. So it needs to be tailored at the level between the feeder fund and the main fund to ensure that the default provisions that are operating are not impacting in a negative way the cash flows that the debt instrument is relying on. And how we kind of see this resolved is really in side letter provisions, which allow the funds to switch on or switch off the default remedies that are appropriate in a debt context. And that's really useful for a fund because they can maintain in their limited partnership agreement the full suite of default remedies that work for equity holders. But then when they have a feeder fund that comes into the structure, by virtue of the side letter, they can tailor the default remedies in such a way that the ones that don't work for cash flows on rated debt are switched off. Moving on to withdrawal, if you think about withdrawal, it also brings in quite a bit of tension due to the nature of the debt instrument and the equity instrument, the debt instrument being the rated notes and the equity instrument being the LP interest. So if you think about debt, when a lender exits a lending facility, they're typically redeemed or repaid in full in cash plus accrued interest. They come out at par. And then if you think about how it works for an equity holder withdrawing for a fund, it's quite different. An equity holder will withdraw at NAV, and that withdrawal can often be effected either in cash or by an in-kind distribution of assets. And so this kind of value point reveals a distinction between the debt instrument and the equity instrument. And that value point is that debt is a par value instrument and an LP interest is a market value instrument. And the value point reveals a tension there where you have a rated debt instrument, which is relying on cash flows from an equity instrument. And that's something that also needs to be managed as between the relationship between the feeder fund and the main fund. And so the kind of headline point with withdrawal is that you really can't have withdrawal effected between the feeder fund and the main fund if it's going to crystallize a loss on the rated debt. And if you think about the feeder fund coming out entirely from the main fund, what are the consequences of that? If it's receiving a cash distribution, is the cash distribution going to be sufficient for the feeder fund to repay principal and interest on its rated debt? If not, it's really more appropriate that the feeder fund receives an in-kind distribution of assets, which can run off in the future and repay the rated debt in the future at that point in time. Looking at kind of the debt level, the level between the node investors and the feeder fund themselves, it's really fundamentally important that the debt is repaid in full in cash. Cash is an objective of measurement where you can ensure that the debt has been discharged in full. It's not really appropriate and it doesn't really work in a rating context for debt to be discharged by an in-kind distribution of assets. But we're kind of seeing, I think, a lot of development in the legal frameworks that are working to resolve the tensions between the debt and the debt nature of the rated notes and the equity nature of the LP interest. I think we're seeing a lot of default remedies being made to work in a debt appropriate fashion, the value point being acknowledged and managed. And I think this is leading to a lot of consensus in drafting and documentation, which is really leading to the potential for further growth in the area and in the product, which is great to see. That's it from me. I might hand back to you now, Eric. Thank you.
Great. Thanks, Katherine. And thanks, John. Definitely a lot of interesting legal and structural considerations for us to digest. For those, as I mentioned, during the opening, many of these points that are available in our research report that we just published called Feeder Fund Rated Notes Squaring the Circle. So if any of these topics are up to you, I would encourage you to download and review that report. So now let's go ahead and shift back to a credit perspective. Tom, I'll turn this question over to you. If you don't mind just discussing some of the key credit considerations that we look at when evaluating rated feeder notes or credit facilities. Specifically, how are factors like loan to value, credit quality, cash flows, how are they incorporated into our rating process?
Yep, absolutely. So I guess first and foremost, we assess all of our funds debt transactions using our investment fund debt methodology. which considers both quantitative and qualitative factors. So this methodology is used for all of the transactions we write here within the funds team currently, and that includes other types of transactions such as sublines, NAV loans, CFOs, and other fund investment transactions that fall within the funds group. As mentioned, it's comprised of both quantitative and qualitative determinants. So from a quantitative perspective, we're considering 5 key determinants being asset quality, asset coverage, liquidity, duration, and a cash flow analysis. And we apply qualitative adjustments based on a manager review, legal review, and then any other qualitative factors which addresses anything that's not ultimately covered by the rest of our determinants. So we differentiate between the transactions that we rate based on the weighting that we assign to each of those quantitative determinants based on the importance of the determinant to that specific transaction. Now, both credit facilities and rated notes heavily consider from a quantitative perspective asset quality, asset coverage, and a cash flow analysis, but the weighting that we assign is different based on ultimately the level of security in the case of a credit facility, obviously benefiting actually more directly on the underlying assets themselves. But maybe starting with credit facilities. So typically in the facilities that we've rated, these facilities can be drawn on at prescribed advance rates that typically consider things like asset quality, assets or borrower diversification, sector concentrations, and lien type, among other considerations. So potentially, for example, allowing a higher LTV if you've got a more diversified portfolio or a better quality portfolio as it relates to the underlying loans that form the collateral for that transaction. The repayment of the facilities then occurs via mandatory cash sweeps and various other structural triggers that will accelerate repayment to the extent the fund breaches those covenants, such as a loan-to-value test or a minimum diversification requirement. So our analysis then heavily, as mentioned, considers the underlying asset credit quality. So working with our corporates team, typically within KBRA, we're assessing the underlying loans, effectively performing credit estimates on the underlying transactions to get a sense of that credit quality on a credit scale basis, but also considering things like the lien type, which obviously impacts things like our recovery assumptions for the underlying transaction. We consider the structural subordination, so effectively then the LTV and how that impacts our asset coverage. We do consider obviously the liquidity of the underlying assets and have a duration component also from a quantitative perspective. But the other large quantitative determinant is then focusing on the cash flow resiliency. So effectively stressing the underlying interest and principal that comes back from the portfolio and flowing those through the waterfall and seeing how resilient the transaction is at being able to mitigate against defaults within the underlying portfolio. As I guess both John and Katherine have gone through, we also, of course, heavily consider other legal or structural considerations. And then from a qualitative perspective as well, thinking about the demonstrated origination and portfolio management abilities of the manager itself. So in the case of feeder fund rated notes, so considering ultimately these notes are then collateralized by the LP interest into, say, a middle market credit fund, the notes themselves may experience different recovery timing and performance profile compared to a credit facility. In addition, at the time of our rating, ultimately the fund portfolio, which is ultimately driving the repayments of the rated note, is generally non-ramped or there's a more blind pool risk within this transaction. And as a result, when we're focusing or evaluating these rated notes, our analysis will heavily consider the fund's planned portfolio targets and restrictions, such as sector or loan concentration limits, as well as will diligence heavily the manager's past performance and approach to investment sourcing and underwriting, as well as the credit characteristics of past comparable investments. And this is really, again, just to assess what the final portfolio could look like in terms of when it comes to things like asset quality, lien type, the spread on the underlying assets, typical tenor, as all of these things will ultimately impact some of the determinants as well as our cash flow analysis. If we can bring up the next slides now. So I guess, got a couple of slides taken from our recent research, which summarizes the typical average credit quality that we see in our rated notes and credit facilities universe. So typically, this is obviously focusing on middle market credit. So on a weighted average basis, looking at, say, a B- or a CCC+ in terms of your weighted average asset quality. And then the chart on the left will summarize the initial LTV by the ratings that we've assigned at issuance. And so typically, again, looking to middle market credit as an underlier, we're seeing something in the, say, sub 50% LTV is required to get into the single A category, and maybe sub 75% getting into the triple B category. But as we've already discussed, there's a heavy focus obviously on the other structural and legal considerations that can ultimately then make a difference in terms of the whether it's cash flow outcomes or other qualitative factors that we consider that can also impact the final rating. I guess, sounds fairly obvious, but we are heavily focused on the underlying documents themselves and how that impacts the repayments of the rated debt, and all of those things then come together to form our final rating consideration.
Great, thank you, Tom. A lot of information there, but very informative. Thanks for that. Min, let's go ahead and build off of the credit considerations that Tom was discussing here. So once we take all of these credit considerations into account, how does that translate into break-even default rates? Obviously, they're critical to our rating analysis and overall assessment process. So can you share some of the data that you have on the break-even default rates that we highlight in the report? And then also we have a question from the audience here asking about whether there's, what type of rating actions we had, affirmations, upgrades, downgrades.
Certainly. So Tom already briefly touched upon the cash flow analysis that we perform for each transaction. So one key output from that analysis is a break-even portfolio default rate that each tranche can withstand without suffering a loss of interest or principal. And that has been extremely resilient. So the top part of this chart shows you the break-even portfolio default rate by initial ratings. And as you can see, there's clearly a correlation with a higher break-even portfolio default rate with higher ratings. In particular, for our investment grade rated notes, they could withstand cumulative default rates that range from 25% to 85%, with an average of 52%. And that is multiples of the default rate that we've seen during the Great Financial Crisis. And even for non-investment grade notes, they could still withstand cumulative default rates ranging from 7% to 42%, with an average of 26%. And it's important also to note that this is assuming a very stressful recovery rate assumption of 53%, which again is much more punitive than historically what we've seen for middle market corporate credits. Now the charts at the bottom essentially lay out for each rating category, both the break-even portfolio default rate multiple and the initial LTV. So the horizontal axis shows you the initial LTV, whereas the vertical axis shows you the break-even default multiple, which is essentially the break-even default rate that this tranche can withstand divided by the expected default rate for that portfolio based on the assumed collateral quality. So for example, if the expected portfolio default rate is 30%, a 60% default rate would imply a 2 times multiple. So what you expect to see, again, is as you go from single A to triple B to non-investment grade, the dots are shifting towards the bottom right-hand corner. And that is the correlation that we generally expect to see. There are going to be some outliers that you see in those charts, and oftentimes they're driven by credit quality that are assumed. So, a single B minus average pool is going to perform obviously better than a triple C plus average pool. The type of assets, lien types in the collateral pool, which would affect our assumed recovery rates. And also, as Tom mentioned, the structure of the transaction, the priority payments, how much equity leakage is permitted in the structure is also going to be a huge driver for those. Now, for the audience question on rating transitions, the portfolio has been very stable with just a handful of downgrades and upgrades since inception. The downgrades that we have seen were primarily driven by, because, the feeder funds, as previously mentioned, they're typically blind pools. So we're making assumptions at closing about the collateral quality based on the target portfolio provided by the manager's precedent fund, assuming, you're pursuing the same strategy and other information we can find. But, as the portfolio evolves, sometimes we do see that portfolios are ramping up more slowly than anticipated, which has certain diversification impact. We've also seen that sometimes the collateral pool has not performed, or the credit profile is different from what we originally modeled. For example, there could potentially be, a higher portion of equity investments, which was initially not modeled. So that would also have an impact on our actions. So the downgrade actions were primarily driven by those factors. But on the flip side, the upgrade actions have primarily been driven by accelerated repayment of the rated notes after the reinvestment period.
Right. Thanks, Min. And a lot of the affirmation have been because it's performing as expected, right? So when you're in your investment period, you're paying down, you're reinvesting and not delevering. So I think they're performing as expected to date. So looking at another question from the audience we have here, and this one centers around how sensitive are we to the waterfall? John, you talked about this a little bit in your legal analysis, and Tom, you touched upon this as well, as kind of looking at the two different waterfalls at the master fund and the feeder fund level. So maybe we can just kind of dive into that a little bit, John, reiterating, how we look at that, how cash gets captured at the feeder fund level and is used to pay down the rated notes compared to releasing to equity. And then maybe Tom, if we can turn it over to you, in how we look at the leverage both at the master fund level compared to the feeder fund level and incorporate the whole look through.
Yeah, thanks, Eric. I think it's fair to say that the waterfall is a key focus of our analysis, particularly when looking at rated note structures. We understand that during the investment period, just as capital is called on a pro rata basis, it's typically returned on a pro rata basis as well, or reinvested, obviously. And sometimes we see a kind of a risk mitigant through that time where there may be an LTV or similar trigger. And if that's tripped, then you'll divert excess spread and kind of bring the structure back into balance. But as we mentioned earlier on, our expectation, generally speaking, will be that once you're out of the investment period, you're in a sequential amortization structure. And that's because, during that time, your asset pool is decreasing, becoming more concentrated. You are now more exposed over time to idiosyncratic risks. So we would expect to see credit enhancement build to sort of take account of that or mitigate that. There are variations on that broad theme, but I guess the point I'd probably make is that it's a balancing act, right? You're trading off credit quality and pool diversification. Maybe you can run on a more of a pro rata kind of pay down for a limited period following the end of the investment period, if there are guardrails around it in the form of credit quality or diversity type tests. But it is ultimately a trade-off. And you're thinking of credit quality, LTV, prepayment risks, and also sort of on the cash flow side, sort of coupons on both the assets and the liabilities and how they develop as you kind of amortize the structure. We also had a question around how we think about line pool risk, given that these are fund investment strategies. So typically the commitments come in and are rated at the outset of a fund during its fundraising period. I'll have a go at sort of starting that answer. I think it's a really interesting point. It's one of the things that really differentiate these fund investment structures from, for example, the credit facilities or other type of structures against similar strategies and similar assets. I think it's safe to say that we need to be pretty comfortable forming a view on the future composition of the portfolio, and then it really comes back to the manager. So this doesn't work for the first vintage unless it's a very well-established team who can point to performance and track record in other funds with other strategies. Typically, we need to see a track record. There's an awful lot of time spent in diligence, and we're thinking of likely portfolio composition and sort of building our analysis on the basis of that. I'll probably stop there and hand over to Tom, who probably has a bit more color on that.
No, I think you summarized it very well. I think the only thing I would add is obviously this only works for certain types of strategies. Middle market credit is our most common rated note feeder fund structure strategy, but we've seen it seen the same technology used for other types of private credit strategies such as infrastructure, some ABL, potentially also things like SRT in some form. But there has to be some degree of, call it, homogeneity within the underlying asset class for us to get comfortable ultimately building the indicative portfolios for how this portfolio could look like once it's fully deployed. And so getting a sense of what the underlying asset quality could be, what the tenor, the yield, the lien type of the underlying collateral. As mentioned, all these things are impactful, both in terms of asset quality, but also our cash flow analysis. And so if we don't have that some degree of, call it, predictability within the underlying assets, it becomes more challenging to provide a rating on those strategies.
And I think just maybe to add to that, I think that touches on another question we've had from the audience around, evaluating strategies that are beyond, go beyond corporate credit and take us into areas like asset-backed, real estate, infrastructure credit. And I think, again, it's to Tom's point about having some kind of confidence around the makeup of the portfolio and the predictability of the underlying assets, and in particular, avoiding idiosyncratic risks. So we can go across the firm and get assumptions and inputs around a lot of the asset-based structures, whether it's consumer credit or mortgage credit, similarly for infrastructure or project finance. But when we get into the realm of real estate credit, that's much, much more challenging. And the reason is it's idiosyncratic risk, right? So it's very hard to construct a portfolio and construct a view on cash flows and performance over time, given just how idiosyncratic those assets can be.
Great, John. Thanks for that. That was the next question I was going to tee up. So thanks for taking that. And I'll just expand on that answer. Is a lot of what we've been talking about is kind of how we evaluate funds that are investing in corporate assets. And to your point, we do have close coordination with our corporate teams and coming up with the credit estimates that, you know, help determine cash flows and default rates and recovery rates, et cetera. But, you know, having previously run the asset-backed securities group, I can personally validate how often we get calls from our funds counterparts asking us to help us evaluate a portfolio of consumer loans, of other transactions supported by various pools of collateral, and that is becoming more and more common, especially as we are seeing funds investing in asset-based financing facilities. So coordination is definitely key, and we get inputs from the various sector experts across the firm. Great. And thank you, audience, for all of these great questions. They're coming in, so I'm doing my best to stay on top of those, but I welcome you to keep those coming. Okay, so let's go ahead and kind of focus on what we're seeing in the market activity. Obviously, with rates where they are and the anticipation that they're going to stay elevated for longer, we're in this higher for longer interest rate environment, and it is creating some headwinds in the financial market. So Tom, if you can maybe just go into a little bit in terms of what we're seeing in the underlying assets and liabilities, whether these are primarily fixed or floating rate, and then with a higher interest rate environment that we're in right now, do you see any shifts in collateral or credit performance as a result?
Mm-hmm. Yeah, so I'll start and cover some of that. Certainly the typical structure that we see usually has a floating rate liability, although there are some that have fixed, and to some extent also some that have a combination of both fixed and floating rated debt at the rated feeder level. But nevertheless, primarily floating rate liabilities. In terms of the underlying assets, again, typically floating. The managers originating these loans are typically originating floating rate debts, but there are again some fixed rate loans within there. And when we're assessing these transactions, we do think about that, I guess, that potential mismatch of how those two things could interrelate. So if there is, fixed rate assets and floating rate liabilities, we'll think about, stressing interest rate upwards to provide, additional stress in terms of the cash flow analysis that we'll perform. But in terms of, the underlying obligors themselves, so as mentioned, typically floating rate loans, clearly the private credit funds themselves are benefiting then from higher interest rates, but of course that could place increasing pressure on the underlying borrowers of the loans. We've, as a firm, published a lot of research in terms of our portfolio recently, and our latest private credit compendium covers all of the corporate assessments we have performed across the firm, which includes all of our funds transactions, all the structured credit transactions, and then any other transaction that incorporates middle market private credit. So we are seeing within that portfolio the effects of a slowing global economy in the data. However, it does appear that most of the obligors have made it through the worst, I guess, of the elevated rates on relatively solid ground. So we are seeing some, I call it, areas of idiosyncratic stress building up, but certainly it feels like for a lot of the obligors, they've made it through the kind of the worst of that interest rate environment. In terms of our fund universe and how that then impacts, of course, our credit facilities and rated note feeders. So there are some, of course, again, some issues or idiosyncratic pockets of the portfolio, but nevertheless, even with some degree of increasing defaults at the underlying obligor level, the structures themselves are also still very well insulated from some credit impact, given things like the structural protections. And also, of course, the origination and portfolio management of the asset managers themselves. So I guess firstly, as it relates to credit facilities, so we see a pretty diversified portfolio in terms of the underlying collateral within the credit facilities that can mitigate against any issues in terms of single name risk. And there usually is, as mentioned on the previous chart as well, the structural subordination that provides that cushion. So if there is any losses, that will first be absorbed by the fund or the borrower. Similarly, for rated notes, again, any losses are then absorbed by the more junior tranches in the capital structure. And so for the most part, there is that cushion, and we haven't seen any sort of significant deterioration within the LTVs or the asset coverage within our rated note universe to date.
Great, thanks, Tom. And we had an audience question come in along the way. I think you touched upon it a little bit, but maybe, Min, I'll bring you in for this one too. The question involves, are we seeing any increase in workouts or restructuring of private loans?
Sure, I think Tom already spoke to some of it, but our Q3 2024 Middle Market Borrower Surveillance Compendium really touches upon a lot of this information, which I find to be very helpful. But we do think at this point, most borrowers in a portfolio have emerged through the peak of rising rates. And what's interesting in that report is that a lot of the companies were actually able to improve their EBITDA in 2024, and hence their interest coverage ratio. So EBITDA growth, this is for the entire population of credit assessments that a corporate team looks at. But the median EBITDA growth was 34% in 2024, and margin also increased by over 200 basis points, which is indeed quite interesting. So we do think that even though PIK relief and maturity extensions have been going on in the last year, we think at this point they should largely stabilize going forward. Although some of the weakest obligors obviously could still struggle somewhat with higher for longer rates. And I think there was also a question regarding the more vulnerable sectors. Again, the compendium has information on the most downgrades we've seen across different sectors. So there are maybe two sectors that I would highlight a little bit. One is healthcare, where in particular the businesses that are most exposed to Medicare reimbursement risk, as well as roll-ups of physician practices, have come under stress. And healthcare is obviously a large sector across the private credit funds. Another sector, chemicals, is a much smaller representation. However, there's also been some pressure as well because of overinvestments in inventory during the pandemic, subsequent industry-wide destocking, weaker demand, and also higher overhead costs. Back to you, Eric.
Great, thank you, Min. Looking at the questions coming in, there was a question on maximum leverage for AAA rating. I would just encourage you, if you want to look at kind of LTV rates, we did have a slide that we shared earlier, and then there was also that data point in our research reports that shows the range of LTVs for each rating category. So I would encourage you to take a look at that or reach out to discuss further. All right, looks like we're pretty much caught up on some of the questions. So Tom, I'll go back to you. Looking ahead, what innovations are you seeing that are shaping the future of the feeder fund rated notes? Are there any emerging trends or structural developments that you think could become more common?
Mm-hmm. Yes, I guess we've kind of touched on some of this already as well, but obviously the emergence of new asset classes coming into the rated notes. Of course, given the anticipated continued growth of private capital in areas such as asset-backed lending, we similarly expect the universe of underlying strategies within some of these structures to grow and evolve. We've also seen a growing number of rated notes, so the feeder fund rated notes being more broadly distributed to investors who are then taking part of the capital stack, which again, kind of allowing those investors to target, who have a target specific risk return in mind when they're looking at some of these structures. In that aspect, because typically these structures are drawn down over time as and when capital is called by the master fund. From a ratings perspective, we then need to consider, of course, that delayed draw and the funding risk of some of those investors as well. So thinking about the fact that ultimately the more junior and equity tranches are providing the subordination for the senior tranche. If there were to be a default by one of those investors on a capital call, that then in turn could either increase LTV or potentially result in the rated notes having a more concentrated portfolio looking into the underlying fund itself. Typically, there's provisions that we see within these structures that would not ultimately put the feeder fund into default on the capital call as a whole as a result of one defaulting LP interest and therefore losing potentially the entire LP interest. But there would be provisions within the agreement that would ultimately then downsize, for example, the size of the rated note as a result of a default by one investor, and similarly, then of course the LTVs would increase. So that's something we have to consider, and potentially, given that the composition, have to have a solve in terms of minimum rating criteria, for example, to ensure there's no issues in terms of that funding obligation over time. We've also seen a growing number of requests for rated notes into evergreen funds. And of course, with the growth of these types of structures more broadly across the market, so too are the requests for rated feeders, rated note feeder funds into these funds. These naturally present some more complexities from a ratings consideration process. Ultimately, our rated note will have a maturity date. And given the evergreen fund itself does not typically have, say, a fixed term, which would obligate the fund to distribute all proceeds back to the investors, say, after an investment period, that then there needs to be some form of solve that effectively converts that process to look very much like a closed-end fund. So, for example, seeing some form of provisions within the agreements that would obligate the evergreen fund to effectively stop investing and start distributing proceeds back to the feeder fund at a defined point in time. So, effectively building in a harvest period into the transaction. Some of these funds as well permit redemptions from third-party investors as well. So, we potentially, again, thinking about that additional risk that could be introduced to our structure, given other investors could submit a redemption request, and again, the master fund having to pay out some of the cash proceeds to satisfy those redemptions could result in a more concentrated portfolio for the rated note itself. So some of those things we have to think about as we're going through our process, but we have ultimately been able to provide ratings on a number of rated notes into evergreen funds that like I say, have addressed and consider some of those additional risks. So overall, I guess we're continuing to see evolution in the space, and obviously given the continued growth in private capital as well, we'll really expect that to continue.
Great. Thanks, Tom. That's a great summary of the trends that we're seeing. While you're speaking, we had a couple other questions come in, one which I missed earlier, but this one, maybe I'll turn it over to John on this. The audience asked, could you discuss considerations for deals with extended investment periods and extended final maturities longer than 15 years?
Sure. I mean, I think it's back to the trade-off again, right? So all else being equal, a longer investment period is adding risk. That might be expressed in lower LTVs. There may also be structural mitigants within the structure that will, again, like the LTV test we mentioned earlier, divert excess spread to bring structure back into balance and sort of respond to the added risk. So that's sort of the extended investment period. Then there was the question also asked about it, like long dated trades, extended maturity dates. Less of an issue for us, to be honest. Actually, our key focus is typically on maturity mismatch. So the other way around, where you've got a short dated liability against longer assets, because that brings up refinancing or fire sale type risk. But again, I think it very much depends on the underlying assets as well, because I think a 15-year trade, if you have 20-year underlying, such as infrastructure, for example, then that's a little short. So, I think there's a couple of different considerations there. I think partly as well, maybe the question was getting at what Tom mentioned around the evergreen structures, and yeah, we've had a separate question on that as well. Seems to be a lot of interest in that. They're really interesting structures, a lot of nuances. They are typically also longer dated structures for exactly the reason Tom mentioned. You're often solving for like a sort of investment or recycling revolving period, and then some period of kind of using some period of time during which you use the evergreen redemption mechanics with guardrails to protect against power erosion to try and redeem the feeder, but ultimately some point in time when it goes into runoff, effectively like a withdrawal account. So a really interesting topic, and actually, a topic that probably kind of merits a session of its own at some other date. We had one other question on vertical versus horizontal feeders, and I think there people had asked about the different considerations. Really, from our perspective, not that much changes. The underlying strategy is the same. The overall liability structure is the same. It does sometimes introduce some additional dimensions of counterparty risk, just because you often end up with very different investors coming in on the equity side. So I'll try and wrap up there.
Great. Nope, that's good. Thanks, John. And maybe just on your earlier point about the term, Tom, I know you talked about the different qualitative determinants that we have, and maybe just an opportunity again, one more time to discuss how term factors into our key credit determinants when coming up with the ratings.
Yeah, so we do. So duration is one of our quantitative determinants. So ultimately, we're assigning a portion of our rating to that determinant, which is ultimately based on typically the underlying duration of the pledged collateral. So in this case, the middle market loans. So that's a smaller consideration in terms of a quantitative perspective, but it can, I guess, as we've discussed already as well, in terms of impacting cash flows, it can have quite a significant impact there, particularly things like, as John just mentioned there, potentially a short harvest period. If you've got very long dated loans that could extend well beyond the life that they exist, kind of the natural life of the master fund, which ultimately, as we ramp up these portfolios again, we're looking at blind pools, so we typically will ramp up the portfolio on some conservative schedule. So for example, over the life of the investment period, which then could put a lot of the duration of the underlying loans beyond the life of the master fund itself. And for any loans that does then extend beyond the life of the funds, we'll have to do some form of market value stress at maturity of the fund instead of receiving back the principal on that loan. And so the haircut that's applied is then typically greater than, say, the 1 times probability of default post recovery principal that you'd otherwise have received on that asset, and so it has an impact from a cash flow perspective. So both impacting things like duration from a quantitative perspective, but also quite importantly into the cash flow analysis that we're running.
Great, thanks, Tom. Looking at some of the questions here, one is, have you rated any feeder funds for asset-backed finance transactions? And that's just, again, highlighting some of what we discussed previously, the growing asset class sector about asset-based lending facilities. To date, we have over 275 transactions with ABL as collateral. So it is something that's been active in the past, and we are continuing to see greater activity with ABL financings. And looking through the questions, I think that's pretty much all of the questions that we have time to answer today. So I'll just take the opportunity to thank everyone for joining us today. Special thanks to John, Katherine, Tom, and Min. Appreciate you sharing your insights on this feeder fund rated note market as well as the credit facilities. And if anyone has any questions or would like any more information, feel free to search our website or contact any of the people included on this call, and we'll be happy to follow up. So thanks once again for your time, and I hope everyone has a great day.